What I want to discuss in today's video is the idea of moving money from your bank account, money in cash, into a whole life insurance policy. And one, if it's a good idea, but two, some things to look out for along with different strategies. So the idea of taking excess cash that I have in my bank account and moving it into a whole life insurance policy can be a good idea. Over the past several weeks, we've had a lot of interest here, specifically individuals reaching out and stating, I want to take money I have in my bank account and move it into a whole life insurance policy as quickly as possible. And the reason why is because I am afraid of what's going on with banks right now. I've lost confidence. I'm uncertain what's going to happen. I'm just not comfortable with leaving a lot of cash there. And I get it. But at the same time, we'll always caution someone to slow down and make sure we know what we're getting into. Because when things like this happen, whenever there's market uncertainty, maybe it's stock market uncertainty, economic uncertainty, whatever it is, often we get emotionally involved. We see other people reacting quickly, they're making decisions without thinking, and sometimes we get caught up in that. And the issue that sometimes occurs, what I've seen happen, is someone quickly gets into a product, then several years pass, they look back at the situation and say, maybe I overreacted at the time. Now they're in a product that they normally would not have taken out for themselves, but they didn't do their due diligence up front. So in this video, we're going to go through the idea of moving money into a whole life insurance policy, but we're going to hit on some other important items. So what I'll begin with is the idea of moving money into a whole life insurance policy. Why people do it specifically, because this is something that people have done for a long time, and there's a lot of benefit here. When you look at banks, when they take out BOLI, bank-owned life insurance, that consists of a large one-time deposit into a life insurance policy, and the cash value looks fantastic. So banks do it too. Individuals can do it. But here's the reason why. When I look at the cash value in a whole life insurance policy, it is a safe, liquid, and tax-free area to position money. Tax-free if I do not trigger a taxable event, such as a modified endowment contract. There are other taxable events as well. I would check out our All About Taxes whole life insurance video. But here are the three core benefits to the cash value in a whole life insurance policy. Now, some history here. Historically speaking, any type of market uncertainty draws interest to whole life insurance, specifically the cash value benefit. I've seen that since I've been in the industry, and when looking at trends, I've seen it before I was in the industry, even before I was born. When I look at a cash value life insurance policy, safe, liquid, tax-free area to position funds, regardless of what's going on in the stock market, in the economy, I know that the cash value will just continue to appreciate over time. As far as the net growth rate, the internal rate of return on my cash value, if a policy is properly designed, I'll go through exactly what that means, and positioned with one of the top major mutual companies, particularly your 4 major mutual companies, that IRR, the net growth rate, could fall somewhere between 3 and 5%. Historically, it's done a little bit better, but 3 to 5% is more conservative, in my opinion, when setting expectations. So 2008, a lot of interest was generated in whole life insurance because people were looking for safe areas to position their money. There was a issue Wells Fargo had back in 2016 with cross-selling, and I remember one specific case where an individual we worked with had a large sum of money with Wells Fargo, and they said, I'm not comfortable with it there. They moved some into another bank account, but they moved a large portion into a whole life insurance policy because they wanted to put it somewhere safe. So that's another example. Anytime there's stock market uncertainty, I'll say for us, 2020 and 2021, we were inundated with individuals wanting to take out whole life insurance. It was one of our busiest times ever. And a big reason why, one, because COVID hit, but two, remember what happened when COVID initially hit? Remember March and April of 2020? What happened in the stock market? Took that dive, went south very, very quickly. Were you panicking at that exact moment? Maybe not, but a lot of people were. And even after that, there was a lot of uncertainty. There still is when we speak with individuals. My point is that uncertainty drew a lot of interest to whole life insurance. And you can look at the history of whole life insurance, particularly companies, how they've weathered storms, whether it's the 2008 financial crisis, you can go back to the Great Depression, you can look at the assets they have on their balance sheet, both assets and liabilities. It is a safe area to position money without getting into all the details today. But here's the big thing, because often what I just went through there, along with the benefits of a whole life insurance policy, attracts people to the product. However, I want to make sure I get it right. Two things we're going to hit on here. Always keep this in mind. Number one, what to look out for. Policies with large premiums. So if your goal, particularly, is cash value, you want to maximize the cash value in a product. For example, I've got cash in the bank. I want to move it somewhere safe, but I want it liquid, like it is liquid in a bank account. I want to be able to access it if I need to. I want to make sure the cash value is maximized. And if I have a large premium, that is going to defeat that purpose. Company selection is also important in my opinion. There's a lot of A-rated mutual companies. I'm very big on looking at historical performance. And why I say that is when you look at whole life insurance or cash value life insurance sales in general, meaning someone's taking out a whole life insurance policy, they're purchasing it, and their objective is cash value. You state, I want the highest cash value possible. Where buyer's remorse often occurs with cash value life insurance sales is someone purchases a policy, often based on what they are shown on that illustration, illustrating how much you pay in, what the cash value and death benefit growth look like over time. But then in reality, the results are much less. Meaning the illustration said you would have $1 million at some point in time, and at that same point in time, you've got 700,000, and you're like, what's up, man? Where's my other 300 grand? We want to make sure that doesn't happen, or at least do everything in our control to minimize the negative impact. So what that has to do with company selection is when we look at actual results, not illustrations, but actual results, what I've always seen to be consistent are policies with the major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, have produced strong cash values. We've got proof of performance. We've seen it time and time again. And when I can see that proof of performance, not just hope that it should produce good results, but actual results, that provides a lot of confidence and peace of mind for me when I'm putting my money there, and especially when we're recommending it to someone else, because we want to make sure that the value is as high as it can possibly be, because we can't control ultimately what the insurance company applies in a dividend rate and what our cash value grows by. The insurance company is in control of that. So that's where company selection is very important. So policies with large premiums. Let's hit on this part because this can be one of the most confusing topics. We're going to look at examples of 500,000 and 2.5 million moved into policies, but let's use 500K for now. Let's say that you're going to move $500,000 that you've got in cash into a whole life insurance policy. Say I've got this money in the bank, I want to get it into a whole life insurance policy. And when it comes to funding a policy, making a one-time lump sum deposit is not efficient focusing on the cash value growth. There's ways you can make a one-time deposit with an insurance company. We'll hit on that toward the end of this video. But let's say this is your goal. You want to move it into a policy, and what makes the most sense from a maximization of cash value standpoint is this. Funding it at $100,000 per year for 5 years. And you say, once I get this money that I have in cash into this policy, I don't want to have to make any more payments. Like, I'm going to get the money in, no more payments. If I can add more, that's great, but set it up so I don't have to pay anything. Okay. So 100K per year for 5 years. Here's the thing to be aware of. This is the most important piece in my opinion. That $100,000, you can choose how much of it goes toward the premium. This is often referred to as the base premium. You'll see that purchase the base face amount on a whole life insurance policy. When you're looking at an illustration, that's the term to look out for, base face amount. Or toward this PUA rider. And really the key is knowing the limits that the insurance company we're looking at offers and how low can you go in that premium, and minimizing the premium will minimize the expenses, and it will result in stronger cash value for you upfront and long-term, especially when you look at the guarantees and, most importantly, historical performance. So with that said, what I just went through, is confusing to many. The thing is, I can have a policy, same company, same product, same out-of-pocket to you, the consumer, where you pay this $100K per year into the product for 5 years, but we've got different ratios. Meaning maybe we've got $10,000 going toward the premium in one example, then $50,000 toward the premium in another example. You'll find that you, A, have to do research to really know what you're looking at, which takes time. A lot of people don't have time. Or B, have an agent that is going to show those different options up front. This way you've got transparency as to the options that are actually being shown. So let's take a look here. And what we're going to look at is $100K per year for 5 years, all with the same product, but it's going to be designed a little bit differently. And here's why we have look out for this. Because if this is you moving $500,000 into a policy, which option do you want? Well, annual funding, $100K for 5 years with all three, options A, B, and C. The one on the left, look at the first year. You've got 88% in cash value right out of the gates. That premium, the item we had in red, that base premium, typically does not show up in cash value in the first year. With some products, it's the first and second year. So here, we've got $100K going in. We've got $88,000 right out of the gates. And what's highlighted in yellow represents your break-even point, which is when your cash value is equal to or greater than your total payments. So by year 4, you've paid in $400 and you've got $405. After year 5, no payments ever, cash value continues to appreciate. And look at this, same $100K going in, but your first year cash value is about $74,000. That's significantly less than the first option. And this is the same exact product, by the way. Break-even point, just about year 5. And then this example, same out-of-pocket to you, but look at this. 50% of it's gone in the first year. I've got $50,000 in cash value. Taking 7 to 8 years just to break even and get my money back. So let's take a look at the breakdown of these policies. Here we go. So we talked about that premium and PUA rider. Here's the exact same policies, but we've got transparency as to where the money is going. So that minimum premium example, you've got a $10,000 minimum premium. This includes our base premium. We also have term insurance attached to the policy. Then we've got 25% premium. What that means is of your payment, $100K per year, 25% of it is directed toward the premium. As a result, that did not show up in cash value in the first year. That's why I've got $73,000. Same thing with the option to the right. 50% toward premium, which is why I only have 50% in cash value, the PUA payment. So this is based on the non-guaranteed values. What happens when you look at the guarantees? Tells a different story. Well, a similar story, but it's amplified here. So as we look at this, guaranteed values, there we go. Exact same scenario, but what do you notice? That minimum premium, where we minimize the expenses, break-even point year 6. When you start raising the premium and looking at the guarantees, you're going to see situations like this. And if you keep on paying the premium out of pocket, that will change things a bit, but you'll typically still see a pattern like what we see here. The lower that premium, the higher the overall cash value. So this is definitely something, in my opinion, to look out for. So we've got transparency on it. And you can see this in a detailed illustration as well. So if we look at the 3 scenarios we just had up, on the left, we've got the guaranteed values. And in the center, when it says non-guaranteed current, that's based on the current dividend interest rate. There's your break-even year 6 in the guarantees. And between 3 and 4, based on the non-guarantees. There's your minimum premium. $9,000 in change. We've got term insurance attached as well, which is where we came up with that $10,000 minimum. I just rounded. Same thing with the $25,000 premium, and then also the 50%. So point to that. The item to look out for is what? If this is you giving advice to someone saying, hey, if you're going to move money into a policy, what would you share with them? Well, if you want to maximize the cash value, make sure that the premium is minimized. They say, what on earth does that mean? If you want to maximize policy for cash value, make sure right out of the gates, you've got somewhere between 80 and 90% of your first year payment in cash value. And that your break-even point is somewhere between 3 to 6 years. That is a much easier way to tell if the policy is set up for high cash value. You may get some pushback on that sometimes, only because when you look at how agents and also insurance carriers make the bulk of their money, it is on the premium piece, because that does not show up in cash value right out of the gates. So again, something beneficial to be aware of there. Let's continue on. Let's look at the next point here. What if I don't want to make payments? So the example we just looked at kind of demonstrated that, and this is something we see very frequently where individuals have funds in cash or other assets, and they want to move a portion of that into a whole life insurance policy for cash value. The death benefit does have a lot of value in those situations too. But if this is you, I just want to move cash, which is very, very common. Here's what we're going to look at. Two scenarios. One, which is identical to what we just looked at, the $500K total amount going in, and then $2.5 million for a larger amount. So there's two ways you can do this. One, you can just fund it out of pocket, like what we just looked at. You've got $500,000 and you move it $100K per year into the policy. Sometimes you'll see individuals position it in a CD or other assets, and they'll gradually take money from the other assets and move it into a policy, but they want to hold on to their money so they can keep control. Some say, I've got it there in cash. The likelihood of me touching it is slim to none. Can I just give you a lump sum up front? And the answer is yes with most companies. I've got this guy here, which is referred to as a premium deposit account. So how this works, if I want to fund out of pocket using the $500K example, what would that look like? Look like what we just saw. $100K a year for 5 years. And this might be somewhere between 3 and 5 years. It's going to depend on the individual's age and health. If you'd like to understand the mechanics of funding a policy with a lump sum, I would check out any of our videos that go through lump sum funding. So you can just type in lump sum on our YouTube channel and you'll see a video pop up. Option B would be you saying, here's $500K. I want to write a check to the insurance company right now, and it goes into this premium deposit account. And then that deposit account credits your money with interest, and it feeds your whole life policy with $100K per year. It's actually going to be closer to $107,000 per year because you're earning interest every year. Now that interest is taxable. Every year a distribution is made from the prepaid account to the whole life insurance policy. Some companies use annuities instead, but when it's in these deposit accounts, that interest typically is taxable to you. So we do want to be aware of that up front. However, once it gets into the life insurance policy, then we've got the core benefits there. Let's take a look at an example here. This will be pretty cool. So what we'll start with, funding it out of pocket. What do we got? Two examples. A, funding $500,000 per year, or $500,000 total, and out of pocket, saying, hey, I'm just going to fund $100K per year because that's the most efficient design. We've got the annual internal rate of return, which displays the net growth rate year over year, and then the total gain on cash value. I like the total gain a lot. It just shows me how much I paid in and what do I have in cash value. For example, by the 5th year, I've got my $500,000 in, I've got $519 in cash value, which is a gain of 19, almost $20,000. Year 10, you added nothing. After the 500, cash value 634, there's your gain. Same thing over here. but a dollar amount that's 5 times the size, 2.5 million. Policy design's identical. Like this is, I like this because it demonstrates, do I have to have a lot of money for this to work? And the answer is no. And in fact, we could even chop a zero off this and see consistency here with a total of $50,000. What do you notice about the internal rate of return in the first year? It's identical. We might look at a different product for a larger dollar amount here, but we see consistency. If all things are equal with respect to how the policy is set up, that's where we're in a position where the cash value is going to produce. The same thing with a long-term death benefit. When you look at the death benefit long-term, the product with the highest cash value long-term will have the highest death benefit long-term. Because at age 100, the two are equal with each other. Excuse me, age 100 with most products. Some are age 121. But anyway, same thing here. Look at that. And that death benefit, by the way, of $8.9 million, kind of an oddball number, has to do with our MEC limit, which is that taxable line on a life insurance policy. With this product and a 45-year-old male, $8.9 million gave him almost exactly a $500,000 MEC limit, meaning we can get $500,000 per year into the policy and still have the IRS view the policy as life insurance, therefore reap the tax benefits that come with it, and not a modified endowment contract and have to deal with taxes, which we've got more information on that in our MEC videos. But there we go. Let's look at the guarantees, shall we? Exact same thing, but based on the guaranteed values, which I always like to look at these, but if somebody's looking at this as far as being a safe area to position money, because I've got funds in cash, if it's me, I would like to see the worst case scenario here too, because I'm looking for a safe asset class. Well, life insurance is that naturally, but if I'm going to look at the safety, what's the minimum guarantee? The guaranteed rate, but more importantly, the guaranteed values. So here we go. Exact same thing. What do you notice? Breaking even year 6 in both examples. That's where you've got your gain here. And remember, this is your annual IRR. So the annual IRR does not have a relationship to the total gain, meaning 1.88% in year 6 represents the fact that it was 2.455. I paid in nothing. It grew to 2.501. That's the 1.88%. If I looked at my average return by year 5, I'd be just above 0%. It'd be like 0.1 if to run it, but very minimal because I've paid in 2.5 million and I've got about a $2,000 gain at that point in time. But it does continue to grow over time. And remember, these are the guaranteed values, a worst case scenario. Pretty interesting. That prepaid account. Let's look at the 500K example. So this is neat because we've got the same $500,000 in. So if this is you and you're saying, okay, I'm trying to figure out if I want to fund it at 100K per year or just write a check to the insurance company, put it in a deposit account or an annuity if that's what they use, whatever. What's the pros and cons here? What is the difference? Here it is. So on the left, we've got the annual funding. This is you paying 100K per year out of pocket. On the right, we've got a $500,000 deposit. You add 500K. Here's what it spits out each year. This is based on the current premium deposit account rates. And this is with Guardian in this particular example. Not all companies have deposit accounts. Different companies have different rates and such. They do change as time passes, meaning when I elect to put money in a premium deposit account, I've got to know what the rate is at that point in time. So the numbers will change compared to what you're seeing here. However, we get about what? About another $8,000 per year paid into the policy as a result. That is attractive to some. Now, I've got the total gain here on the right, negative $400,000. Why is that? The reason why is because in this scenario, we are assuming you write a check for $500,000. Once it goes into the account, that deposit account, what do we lose? It's not liquid. Or if we do access the funds in that deposit account, there's typically a penalty associated with that. So when it becomes liquid is when it goes into the policy. So first year cash value, $95,000 and change. I'm looking at it this way that I paid in $500,000 total up front, and I've got about $100,000 less than what I paid. I mean, $400,000 less than what I paid. Now, the flip side, by year 5, I've got a significant gain, $61,000 compared to over here, almost $20,000. Again, how I did this, some may agree with it, some might not, is just the initial deposit, because I paid $500 out of pocket. Now I've got $561 in cash value. The only thing that we would need to take into consideration are the taxes due on the earnings of that prepaid account, so the extra just about $40,000. That's the only thing we do want to account for, and we could say, hey, that's going to pull down the returns or the total gain a little bit. It will, but I think you see where I'm going with this. There's the total gain on cash value. You also have a higher death benefit, which is nice. And we had to make it higher, really to prevent the MEC from occurring. But we paid in an additional $40,000. That's what went into the policy. And by year 20, how much more life insurance do you have? You're at 1.75 compared to this, 1.62. Not bad. About another $130,000. Which death benefit proceeds are paid out? Income tax-free. Last tab to look at, the $2.5 million deposit account. Or first 2.5 paid over 5 years, and then 2.5 in a one-time lump sum. There's the deposit account. There's what's coming out each year. Sweet. And one thing about these deposit accounts, you can often set them up after a policy is started. What you could also do, which I kind of like the idea of, is if I have a policy where my base premium, in this example, is about $50K, well, I can make a premium deposit for, call it $250,000, specify that that just satisfies my base premium. Then anytime I add more money to the policy, meaning I'm moving money from another place, I'm just throwing it right into PUA, so I can somewhat prepay the piece, the base premium that most people don't like as much, especially in the first year, but then have fun with my PUA payments and add them at discretion. Just a thought there. And the company flexibility is very important there too. So I hope that you enjoyed this video. I had a lot of fun with it because this is something that frequently comes up. But the 2 items to look out for, one really is that policy design. Watch out for a large base premium, because if I start moving money that's liquid in cash to a policy and lose that liquidity, then find out after the fact it could have been set up where I had it up front, that's usually where people get upset. So I do want to be aware of that. And then second, do I have to make payments for a long time? Often people do not when they're interested in the strategy, and you do not need to do so. We had 5-year funding scenarios in this particular example. It is possible to do it in a shorter time period. Typically 3 to 5 years is the sweet spot. Age and health do play a role there, so there's some other things we want to look at. And again, we can get pretty technical when it comes to lump sum funding. But anyway, my point is we definitely want to look at that, and it is possible, very easy to fund a policy with a lump sum. Hope you enjoyed this video. If you did, please hit the like button, subscribe for more. Let us know if you have any questions or comments. Feel free to leave them below, and I hope this helps. Thanks so much.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.